All right, everybody, it is Thursday, January 20th. Another disappointing day with the market down late, giving up all of its gains and tumbling pretty bad. Now, I think this came as Biden kind of endorsed Powell's and the Fed's plans to tighten monetary policy. It seemed like the market sold off when basically Biden gave a green light to Powell and the Fed to probably go aggressive on rate hikes. That's what it seemed to me. So let's break it all down. First of all, let's go over again what rate hikes mean. Rate hikes are price increases because the cost of credit is reflected in the cost of all goods and services. So when you raise rates, if this is the Fed's strategy to squash inflation, this is not going to squash inflation, at least not immediately, because you're raising the cost of everything because the cost of credit is reflected in the cost of all goods and services. It's passed along as a higher price. Number one, rate hikes are also fiscal expansions because the government necessarily will have to pay more interest, via that interest channel into the economy. So they're going to end up paying more on T-bills and more on bonds and notes. That is a fiscal flow into the economy. So on the one hand, you have a price increase and you have a fiscal expansion. Now that we got that out of the way, I understand, people are programmed into behaving a certain way. When they hear about rate increases, they automatically want to sell stocks. When they hear about rate cuts, they automatically want to buy risk assets. And it's not so linear. It's not as linear as you think. It's not, that correlation is kind of spurious in the long term. I mean, in the short term, what you're seeing is just human behavior. It's trader or investor behavior. And I'm not saying that's right. We've seen, and I've highlighted many instances in the past here on this channel of how investor behavior is counterproductive to their own, goals, right? I mean, they end up losing money because they jump in, they jump out, they don't have patience, they react to headlines. Their knowledge is very limited on, how the monetary system functions. They buy into a lot of these ideas and paradigms that are not applicable or to the current reality. So we know how they behave, and we can step aside and allow that to play out, and then there's opportunities in there. As far as the fiscal flows, again, they're down. Of course, they're down from the high levels we saw last year, but they're basically right now the same as where we were in October and December. I mean, we did lose the child tax credit payment, but we're running about 22 billion a day, and that's the 10-day average of the flows, and I think we're probably up closer to around 25 billion, and that's a 500 billion monthly flow. That's not terrible, as I've been saying. I mean, pre-pandemic, we were averaging about a 420 billion monthly flow, and that was perfectly okay to keep the economy growing at 2 to 3%. The deficit, I've been telling you about that. The government, the federal budget is we're running basically like a balanced budget. Now, I did a video on that yesterday, and that's not good. Okay, again, the swimming pool analogy, there's no water left in the pool. I mean, they drained it out with this balanced budget, and that is not good. But I don't see that as an imminent danger to the economy, and I'll tell you why. We're in the midst of a credit expansion. By the way, I just checked the numbers today. Another a 107 billion decline in reserve balances at the banks in the week ending yesterday, January 19th. And in the last, I believe it's the last 4 weeks, we're down 452 billion in reserves have dropped 452 billion. We're down to like 3.89 trillion or 3.87 trillion or something like that. That's the lowest level. I got to go back and check, but it's at least the lowest level in at least 7 months, if not longer. All right. Now, what does this mean? Again, this drop in reserves, it frees up space on bank balance sheets. So I'm pretty sure when I see the numbers tomorrow in the Fed's H.8 release, and you could look at that yourself. It comes out on Fridays at 4:30 Eastern time. You just Google H.8 release, and I'm pretty sure we're going to see another big jump in loans and leases. And we're also going to see the banks as heavy buyers of securities, meaning treasuries, agency securities, and MBS. So a lot of people are selling, speculators now, and you could check the CFTC's weekly commitments of traders report, and you see that speculators are heavily shorting the treasuries. Banks are buying. I mean, they're buying, at least in the cash market, they're buying cash treasuries, they're buying MBS, they're buying agencies. Those numbers you can see. Last week, I think I mentioned 50 billion in 1 week of MBS purchases by the banks. That was the biggest 1 week purchase in history. I mean, that set a record, okay? So they're buying. And short term, I mean, they're taking some losses on those positions because, as rates go up, bond prices fall, and those are marked to market on the books of the banks. So we actually saw their holdings flip negative for the first time in, I believe it was like first time in 3 years. But that's a temporary thing. I mean, we had that back in 2019. It flipped negative. Went negative for a while, big time. I mean, that it was negative to the tune of 50 billion. In the most recent report that I saw last week, it's negative 5 billion. But those losses will grow in the short term, and that's a little bit pressure, I would say, on bank stocks. But that, longer term, they're still looking pretty good. So the breakdown is this. Oh, let me also mention that sentiment. I went over the American Association of Individual Investor weekly sentiment survey today. Bullish sentiment was the lowest since July 2020 or 2000. Was it 2020? I got to go back and check. But it's really, really low. Bearish sentiment was really, really high. So you have at least a market sentiment condition that is conducive to a turnaround, and I would say a big turnaround. But the most important thing to me, as always, that's the fiscal flows. Yes, they have moderated. They're not terrible, but I think the flows combined with bank credit expansion, I don't think you can get really too bearish on that, to be honest with you. I went back and I looked at the last time the government ran a surplus, which was during the second term of Bill Clinton. And, that was his big political strategy engineered by his advisor, Dick Morris, at the time. Said, hey, we're going to beat the Republicans at their own game. They started to do this in advance of his second term, when he was up for re-election. What was that, in 96, right? We're going to beat the Republicans at their own game. We're going to become fiscal conservatives. We're going to balance the budget. So that's what he did. He balanced the budget and he put the budget into surplus, and that triggered a big recession and a market crash in early 2000. But it took some time for that to happen. Now, I went back and I looked at debt service burdens. I talk about this a lot. Like, what was the percentage of the debt burden as the debt burden as a percentage of disposable income back then, like in 1998, 1999, 2000, when they were starting to run a surplus, and it was up around 11, 12%. Right now, it's 9%, which is very low. And I mentioned several times that in 2007, when we had the great financial crash, it was up at an all-time record high of 13%. In other words, debt service burdens in 2007 was very high. Debt service burdens in 1998 to 2000, that was high too. And the government was starting to run a surplus. So I think we got room. I mean, I think we still have room for a credit expansion. If there's a credit expansion and we're still running at, let's say, 400 to 500 billion a month in fiscal flows, I don't know. I don't see that as terribly bearish. I just don't. Now, I understand the emotional reaction on the part of investors when they hear about rate hikes, because they've been like so programmed into thinking that is a bad thing. When you really understand what it is, again, that's a redistribution of income. That's just some sector of the economy, some cohort loses, some cohort gains, just like inflation. Producers gain, consumers lose. As I say all the time, the income doesn't fly out into outer space. And with the rate hikes, again, that is a fiscal expansion through the interest channel. So I'm not freaking out right here. I mean, I'll be honest with you, I don't like the fact that they're balancing the budget. And I just think that, I mean, it's not so much even Biden's fault as much as I think he's doing a terrible job. But he has not been able to pass new legislation or any new stimulus. So, and like I said, the automatic stabilizers work in reverse too. When the economy grows, then the amount of tax collected grows too, right? That's an old Republican thing of supply side economics. I mean, but the problem is the tax collections grow faster. At some point they exceed the spending if the spending is not sustained. So then you start to narrow that deficit, you start to suck out financial assets from the non-government, and then that's their savings, goes down. That's the water in the swimming pool, down to nothing, right down the drain. I don't like that part, but I think we still have time. Anyway, let's see what happens. We could get a bounce based on extreme negative sentiment, and then maybe you want to sell into that. But we have to take a look. Again, there's a credit expansion underway, and 400 to 500 billion a month in flows. That doesn't seem terrible to me. I think the economy is going to be okay. All right, everybody, that's it for today. See you tomorrow. Bye.